Major currencies are failing. I'm your host, Steve Van Metre, and thanks for joining me today. And central bankers around the world are panicking as major currencies are in free fall and they're powerless to stop it. Let's over to Bloomberg, where we picked today's story up with a headline: crisis level risk loom in Asia as major currencies crack. The yuan and yen are both tumbling due to the growing disparity between an uber-hawkish Federal Reserve and a dovish policymakers in China and Japan. While other nations are digging deep into foreign exchange reserves to mitigate the dollar's damage, the yuan and yen slump is making things worse for everyone, threatening the region's mantle as a preferred destination for risk investors. So what do they mean by digging into reserves, foreign exchange reserves? Well, outside the U.S., countries hold reserves in dollars and in U.S. treasuries. So when they need dollars, when they're short dollars or their currency is collapsing, their immediate place they go to is their foreign exchange savings. So what they might do in the case of Japan last week, they would actually take some of their dollar reserves and sell them to buy yen back. The concern the market has right now is these countries don't have an infinite amount of reserves. The renminbi and yen are big anchors in their weakness risk destabilizing currencies to trade and investments in Asia. Now, this is another good point, because what's happening here from a trade's perspective, if a currency is falling and falling quite rapidly, well, it's really not something, an incentive for people to trade against. So if you think about perhaps a new order that's placed in the U.S. to a factory in China, well, that might take months before the product is built and delivered to the U.S. where payment comes from. Well, if the currency, if the yuan is collapsing, again, then there's trade going on yuan, which we know, of course, that doesn't happen between the U.S. and China. But just to put this in perspective, if a currency is collapsing in that relationship, well, then you have an issue of the trading partner is losing money in the trade of the production of goods and services, and that's not good. That is actually incentive to not trade. And what you'll see around the Asian area is people trading with China and Japan in their currencies are going to have a less desire to continue that relationship. We're already heading toward global financial crisis levels of stress in some aspects. Then the next step would be the Asian financial crisis if losses deepen. The tumble in the currencies of the region's two largest economies may swell into a full-fledged crisis if it spooks overseas funds into pulling money out of Asia as a whole, leading to a massive capital flight. Alternatively, the declines may set off a vicious cycle of competitive devaluations and a slide in demand and consumer confidence. Again, we come back to that concept of trade. When the currency is declining, people lose confidence. They don't want to trade in it. They may even take their business elsewhere. But of course, again, you see this pull out of capital coming. And what have I said over the last couple of months is likely to happen? Even though we hear countries say, we're not going to devalue, do not worry, it's not going to happen. When push comes to shove, what do? Yeah, you bet. They're going to devalue. Beijing and Tokyo's heft is even more pronounced in financial markets. The yuan makes up more than a quarter of weighting of Asian currency indices, according to recent analysis. The yen is the third most traded global currency, so its weakness has an outside impact on its Asian counterparts. The rising potential for spillover between the two largest regional currencies and their smaller peers can be seen in the fact that they're moving even closer to alignment as the dollar surges. And so there's another factor here that's going on that we wouldn't see here in the United States, is that outside the U.S., people borrow in dollars. Now, it wouldn't be unlikely someone in the U.S., you don't hear people talk about, hey, I borrowed in British pounds or I borrowed in Japanese yen. Well, outside the U.S., it's quite common that people borrow to get dollars. Well, guess what? You have to pay a dollar-denominated loan back. You got it, with dollars. And so when the dollar is rising and their currency is falling, it takes more of their currency to get those dollars, and you lead to an all-out crisis, which means it's a debt default issue is what we're talking about. The most vulnerable currencies are those with deficit current account positions, such as the Korean won, Philippine peso, and to a lesser extent the Thai baht. When the yuan and yen both fall, the pressure can translate to dollar buying and hedging demand for those exposed to emerging market currencies. So what you can see is during trade and other aspects in this relationship, that in a free-falling currency, you can see it leads to more hedging and dollar purchasing, which just exacerbates the dollar going higher and those currencies falling. But one thing that shouldn't lead to a full-fledged crisis is your portfolio, should we end up in another Asian currency crisis. I'll put a link up here to Portfolio Shield and description below, because it's not just Asian currencies that are getting crushed. The British pound is getting pounded. Here at the Wall Street Journal, the British pound bonds roiled as tax cut plans spook investors. The British pound briefly sank to its lowest level ever against the US dollar on Monday before pairing losses. The currency touched 103.49 during Asian trading, breaking through its previous record low set back in 1985. The pound's fall followed a tumble of 3% on Friday after the government announced a series of tax cuts for businesses and individuals. That marked the currency's biggest one-day decline since the beginning of the pandemic in 2020 and its second biggest fall since the 2016 vote to leave the European Union. And the tax cuts will hit the government revenue at a time when the government has also unveiled massive subsidies to consumers and businesses over the next 2 years to shield them from the worst of far higher energy prices due to the war in Ukraine. Taking together, the size of the plan spook markets at a time when inflation is already running high and the Bank of England has been raising interest rates quickly. So what you're seeing here now is an issue of where policymakers are directly being opposed with central bankers. So central bankers are trying to quell inflation by raising interest rates, restricting demand, and policymakers are saying, hey, back in the pandemic, we gave you a bunch of money to get through the pandemic. That ended up creating inflation, so now we're going to give you a bunch of money to deal with inflation. And that's why you're seeing the markets get spooked and why you're seeing currencies sell off. Whenever you hear a policymaker come out and say, hey, we're going to forgive loans or give away money or do something, and now all of a sudden you're seeing that happen in Great Britain, and that's why the pound, well, it's getting pounded. If the UK government doesn't backtrack, it'll find itself at odds with the central bank pulling in the opposite direction as the government spends more money and the bank makes borrowing money more expensive. So again, you have the second side of the story is governments need to borrow more money to give all this money away, and they're going to do it at higher and higher interest rates, and that's just going to strangle the economy as governments need to borrow all this money. It just takes away the power from the real economy who needs dollars and needs money, but the government takes it away, and you'll see that happening around the rest of the world too. Japan warns against speculative yen moves as markets wary of further intervention. Again, we see the yen in free fall as Japanese finance minister Suzuki said authorities stood ready to respond to speculative currency moves, a fresh warning that comes days after Tokyo intervened in the foreign exchange market to stem yen falls for the first time in more than 2 decades. What they did was sell some of their dollar reserves. Still, Kuroda warns of heightening risks to Japan's economy and stresses resolve to maintain the ultra-low rates blamed by analysts for accelerating the Japanese currency declines. Again, nothing to do with the fact that they're easing. If risks to the economy materialize, we will obviously take various monetary easing steps without hesitation as needed, suggesting that what Japan's going to do and why the yen is going to keep going down is they just said, look, if our economy slows down, we'll do even more easing. And that is, again, part of the problem we're seeing here. It's all of these central bankers are trying to mop up this alleged printed money from the pandemic. Some of them are, some of them aren't, and it's leading to these outright collapses and these extreme events. And now we'll head back to the Wall Street Journal, who carries the story on. Central banks may stoke risk by raising interest rates together, and that is the problem we're seeing now is they're not all together. Central banks around the world are raising their key interest rates in the most widespread tightening of monetary policy on record. Some economists fear they may go too far if they don't take into account their collective impact on global demand, an issue we've been talking about on this show for a long time. Though central banks are almost universally responding to high inflation, as inflation across the group of 20 leading economies was 9.2% in July, double the rate a year earlier. Higher rates cool demand for goods and services and reassure households and businesses that inflation will be brought down over the coming year. But the problem isn't that it won't bring inflation down. The problem is, will we get a recession, perhaps a global recession, maybe even a global depression? What do you think about that? Well, we'll take to the comments. We'll see what your thoughts are. The present danger is not so much the current and planned moves will fail eventually to quell inflation. The issue is that if they collectively go too far and drive the world economy into an unnecessarily harsh contraction, and that's what we're likely to see. And we didn't talk about oil, we just talk about the economy slowing down with this headline from Bloomberg as oil falls as wrecking ball dollar piles on commodity losses. So what you're going to hear is this talk about how commodity prices are headed down just because the dollar is rising. I want you to also think of it as a demand issue. Let's continue on with the story. Crude is on track for a substantial quarterly slump as leading central banks, including the Federal Reserve, raise interest rates aggressively to fight inflation, hurting the outlook for energy demand and sapping investors' appetite for risk. The Fed's tightening has helped drive the U.S. dollar to a record, making commodities prices and the currency more expensive for overseas buyers, and that will slow down demand. The upward pressure on the dollar is a wrecking ball for commodities as the supply-demand balance has caught up, and we're entering the fourth quarter. We're starting to see inventory of crude building. And why does that matter? Well, it matters for one simple reason. When you see the dollar go higher, and if you see crude oil come down as a result, it's telling you that financial conditions are tightening. As far as inflation goes, the chart we look at on this show on a regular basis is the relationship between consumer prices and West Texas Intermediate, both on a year-over-year rate of change. Here we see the CPI in blue and West Texas Intermediate in red, suggesting that consumer prices are likely to come down. And while consumers may get excited about this, you won't hear oil companies get too excited about it, because what happens for these commodity producers is they had to raise prices too. They had to give raises. They had to increase their benefits. They have inflation as well in their expenses. So when commodity prices come down, there's a reason why we looked at this chart a couple of days ago. The relationship between crude oil and unemployment claims is because when crude oil starts coming down at this point, what do you see? Layoffs are coming. And to further extend on this, let's head over to the desk of our chief strategist, Jeff Snyder. In his daily, he notes in the commodity slab, in the given recession impression sweeping money markets, commodities have naturally been caught up in the deflationary maelstrom. Falling demand and expectations for worse, along with true inflationary money, the recession pricing piles up, just like the data and the curves. Now, if you want to know more about what Jeff has to say, this is your final week. There's 4 more emails going out before it goes paid. So if you want to get it for free, jump on the link in the description below, Markets Insider Pro, and you're going to get a special discount when we go paid. But all he's saying is, look, this drop in crude oil prices isn't just a function of the dollar. It's a function of demand. And if demand goes down, well, that means we're likely headed to recession and potentially now a complete currency crisis driven by the dollar heading higher. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.